Hello traders, welcome to FreeFX. I'm Francesco. Today we're going to talk about the SPX and the CPI, main focus points for this days of trading. And obviously today is Thursday and we end the week very shortly, so we don't have long to go until we close the week and see what happens next. So now here's the SPX, and I've changed the chart a little bit since the last time. So you don't see the Bollinger Bands anymore, or the 21 WMA, or the simple moving average, the basis for the Bollinger Bands. You don't see the pre-pandemic level high, you don't see the 21 WMA weekly, you don't see the the June low, you don't see any of that because I've taken out all of that from the charts. Why? Because I wanted to create this parallel channel, in fact two parallel channels. That's what I usually do. Whenever I use parallel channels, the channels are inside each other, so you have essentially a band. And this band manifests itself by having this layer, which is the sort of filter, if you like. There's kind of, if you like, it's kind of like two levels, a bit like Bollinger Bands. You can have double Bollinger Bands as a filter. So you've got, say, 2x standard deviation, so 2 standard deviations, or you can have 3. And so between 2 and 3, you get this sort of area, which is like a border zone, if you like. And that's kind of where you filter your direction long term. So if you get reversal like in this case and stay within and come back, that's kind of a safe place to short. And if you go long within this, it's a safe place to go long. Obviously we've had this peak above this band, but if I just undo all that, and you can see that if I just expand that a little bit more, we've had these before. So I just move my face, and let's take this one here. Okay, there's been one peak above there. In terms of this, we've had a long wick here. So let's kind of mark some of them. This one, long wick there. Okay, so, and if you look at the dates, that one I just marked there was back in, April. This one here, more recent, August. And we had this one here in September. So April, August, September, that's 3. And now in November, so probably I think it's going to be another one of those wicks here, and so even if we get to this point, okay, let's just kind of assume that that's not the case. Even if we get to this point, so we get to the upper level, this would take us to about 4,000 something, okay, 4,000, and then likely is that we'll come down in some way, either to the middle bit, sort of the mean reversion, if you like, like we did here, okay, and stay there for a bit. And then maybe bounce back and then go. So that's the plan, which would take us about 3,300. You know, that's 3. That's a terrible way to write. Actually, some word of text anyway. So let's call it 3,300 there. 3,300. Okay, so that will take us about there. So having done all that, that's kind of the homework really. The big news is this rally here, CPI. How big is it? Well, this is a weekly altogether, so if we take the weeklies, we had something of this magnitude. If you take this here, for example, you know, that was pretty much the same. So this one was about the same. We could measure it, I suppose. You could do that and take the ruler and just go top to bottom. What's that? That would have been about 5%, maybe a bit more. And that's kind of what we have today. So this candle is the equivalent of this candle in let's come off there, what was it, June. So this June. So after the June low, we had this big kind of rally, and then we had this triangle, if you remember the ascending triangle, around about here. So lots of interesting things. But let's talk about what happens with the CPI, generally speaking. So if I take all of these off. The CPI is an interesting one because if I go to so the 13th of the month, or the sort of Thursday or closest to that, the second Thursday of the month. So today was the 13th, sorry, the 10th, and the previous one was the 13th. Let's go to the 13th of October. So that week would have been here. And we had this sort of big mess, and it sort of went down and then up, and then a whole mess occurred, and then we sort of shot up. So that was that. So CPI, let's call them CPI. So CPI there in October. Okay, CPI. And then we had the one in September, which was also very interesting. That one there. So I keep talking about CPI day. That one in September was very good. Okay. And that took us down. Big wick there, etc. So this is a green candle, interestingly. We are at that border, and so is this. So CPI, CPI, and CPI. Okay. So this candle here, this candle here, and this candle here. So kind of different ones. A big red candle with a long tail to the upside wick. A big green candle with no particular wick at the top or bottom, and this one with a larger wick at the top and quite small body. So all very different ones. And if we went back to September, August, something on the 10th, this one maybe? 8th? Yeah, this one. This one would have been a CPI week. So assuming that's CPI week there, that's kind of what happened there. So, you know, it seems to be that it varies a lot, and then we have to look at the data. But I just did a post on Twitter about the CPI in August, because what happened then is that we had quite an elevated spike on the CCI, not CPI, but CCI, which is the Commodity Channel Index, which is what I refer to a lot, because it's this one at the bottom here. So the CCI was very elevated, and on the weekly, by the way, it's a very different story, because on the weekly, I was talking about the 4 hour and the hour, actually, the hourly chart. On the weekly, you can see there's quite a lot of stuff going on, but if I just bring up my post, it was to do with the CCI hourly. So let me just bring that up, because it's probably going to be easier to find that. It was to do with the spike that was quite unprecedented, and I look back at the August CPI reaction, and that was really, there it goes. Alright, so the post says 10th of August, near the end of the summer, quote unquote, bear market rally. Okay, and then it says CPI cooled slightly. I suppose CPI cooled slightly, and the SPX popped, not as hard as today, pushing the hourly CCI to a massive 449. Okay, so the August data was that was the CPI core inflation rate year on year. So looking at July, and that was basically what came out. Previous 5.9, actual 5.9, consensus was 6.1. I think that's what it was. Inflation rate came softer at 8.5. So you know it was basically softer by a little bit, and the CCI sort of shot up. So let me just bring up the CCI. So that's what happened on the 10th of August. We got this massive spike to 449. Now the CCI is set to 100 and minus 100. I set it to 200 as a filter, because it's very, very unreliable. If you go to the 100, it goes there a lot, usually, especially on the shorter time frames, but the 200 is a very good filter. And so when you get to double that and more, that was 449, that's a big spike, and then leads to a quick reversal and negative divergence, just like what we've had today. And so then what we had there was that within about a week, we had a retreat. So from the end of that bear market rally, we dwindled around the 21 weighted moving average on the weekly chart, and then about a week later we started seeing a pullback, and then that led to what we know, in August. Again, that's here, and we saw that what happened later. So if you took that move there from there to there, and then sort of replicated it from here or 4,000 to here, depending on how long it takes. This one took 1, 2, 3, 4, 5, 6, 7 weeks to get to the bottom. Okay, so let's say from next week, 1, 2, 3, 4, 5, 6, 7 weeks. That would take us to this level, 3385. So, you know, 300, 400, you know, that's kind of the number. And, you know, that's kind of achievable because then 339 something is the level of the pre-pandemic high. So we're talking constantly about that sort of number. And so that's kind of what we get to, which is a fairly achievable number, if you ask me. But then, you know, I'm kind of biased because I'm kind of wanting this to happen. So, and you don't always get what you want in trading, do you? So, but it'll be about here, as I said, about there. So that's the kind of target. So if you wanted to really visualize that, we'd probably do a line, say arrow or something, and do something like this. Just make it really, really basic. Okay, so that's kind of where we're heading to. Now we'll make it a little bit thicker, and that's, you can see that. All right, so let's say that that's what happens. It won't happen in a straight line, obviously, but that's what we are. What's interesting about that is that we had a big pop today as well. So, and again, I put that on Twitter. So that's the pop we had today here, and then the pullback. So you know that really tells a tale of things. And by the way, that's Kim replying there. If you've missed that interview in my previous video, please watch it because it's a very good insight into retail trading and sort of somebody who's managing you know, profession and also trading on the side, as myself and others do. So it's really interesting for that. So I'm just kind of giving you a little nod there. So essentially that's kind of what we're looking at for that. The weekly though is interesting because the CCI, as you can see, I'll just do a few more of these. We've got one. I'll recenter these two. Okay, one here. So I will copy this, clone, and then clone again. Put it to here. So that's kind of where we are. So why am I doing this? Because we need to highlight the importance of this. So I'll just do one here. That can do it there. Okay, fair enough. Okay, so you can see the correlation there between these. So we've got essentially this one takes us right up to this level, and the CCI is basically just saying that, hey, we're basically going to, now the CCI, of like all indicators, is a lagging indicator, but it calculates previous price, and it calculates essentially uses the moving average, and it calculates mean reversion as well. So if I just put up the CCI Investopedia, you'll see the definition there, and you'll see that it's at the recipe, I mean the formula. There it goes. It's mean deviation, except mean reversion, mean deviation, and typical price. Okay. So moving average, then we've got mean deviation, and the so that's kind of the formula how it's got to. So calculate the mean deviation by subtracting the moving average from a typical price for the last 20 periods. I calculated 21. So sum the absolute values, ignore the minus in these figures, divided by 20. So CCI, what will it tell you? It's used for spotting new trends, watching for overbought and oversold. It's an oscillator. It's unbound, obviously, so watch for a pullback in price followed by a rally in both price and CCI to signal a buying opportunity. So divergence is very important. It's exactly how I use it. Okay. Above zero indicates the price is above the historic average. Okay. Above zero. And now we are not above zero, as you can clearly see. In any of these, we had this peak here in the 40s, but that's about it. So if I do a vertical line in these places, put it there, and I put one here. Okay, so these vertical lines are really just to highlight what the exact points are, and then do a third one here, just where we are now. Right. So what do all of these have in common? Well, I could actually give you more examples, like take that one for example. Except we don't have any sort of boundaries here. So that was the uptrend. So they kind of, we're above zero there, and we got to below zero, and we're still below zero. Okay. So if we look at the previous stretch, obviously we had the pandemic there, that sort of V-shaped recovery. But if we look at that, essentially before that we were staying above zero, and then we were below shortly, and then we sort of went back up. So essentially it's the reverse. How many points do we have touching on the zero line there? And we had 1 there, 2 there. Well, this was kind of flatlining almost, and that was shooting up. So long period of diversion there. But before the pandemic, we had 1, 2, 3, and that was the 2018 that Kim mentioned in the interview. Actually, that was sort of late 2018, very, very bad week. So that was there below. And before that, again, if we look at sort of pure uptrending, I would say that this is probably a good example there. We've got lots of touches there as well. So, and price is doing this essentially. What I'm trying to demonstrate with this is this: when you have a strong trend, this oscillator on a weekly is doing a lot of staying within the boundaries of the outer band and the neutral line, the zero level. Okay, so in this case we've got 3 key points, and each of these points has been a turning point, and we just come into this again, to the zero. The fundamentals haven't changed. What are the fundamentals? The fundamentals are that, well, there's a recession basically, whether you like it or not. It's kind of how we are. So 2-3 month spread, that's kind of what economists look at, and this is telling us that we have, technically speaking, a recession. So it's inverted, as you can see. If I do a 5-year, that's kind of what you see. So when it's inverted, that's in 2018-19. So the 19 one was kind of signaling maybe the pandemic, you could say, but that's kind of very hard to say. We can look further back maybe, or right, need a, okay. But we've inverted essentially, and that's a signal for recession. So the difference between the 10-year treasury rate and a 3-month treasury rate, the spread is widely used, I'm reading here, as a gauge to study the yield curve. When it approaches zero, a flattening yield curve, a negative 10-year to 3-month spread has historically been viewed as a precursor or predictor of a recessionary period. The New York Fed uses the rate in a model to predict recessions 2 to 6 quarters ahead. So we kind of gone below zero in November. Okay, so 2 quarters ahead is not very long. Obviously, we're looking at summer. So yeah, that's kind of not very reassuring. So that's not changed. What else? Let's have a look at this. So Federal Reserve funds rate. We've got the Fed there, and we can look at that's the funds rate. That's kind of where we're going. But what I want to look at is, well, let's talk rate hikes. Okay, so everybody's kind of focused on, is the Fed doing this? Is the Fed doing that? Are we pivoting? Are we not pivoting? So we had the this period there, 2005 to 2008. Then we had the QE 1, 2, 3. Then started raising rates, obviously, and then reversed on that. We've obviously gone past this peak from 18-19, and that's where we are. Okay, so we are at levels that we have seen before, and we're trying to get to a point where inflation is under control. So, but we're not seeing the levels of the 80s, obviously, where we had rates up to nearly 20%. So we're certainly not in those situations there. I believe that the grey areas are sort of recession areas, recessionary periods. and you know, in this recession period we had the QE obviously, or cutting the funds rate effectively. So, and kind of that's what we get from this chart. I was actually trying to find something, but I'm not sure if I will see Federal Reserve balance sheet. That's what I'm looking for. That's the one. So recent balance sheet trends, total assets, Federal Reserve. Let's see if we can find it. Maybe not so easy. Okay, so that's the let's try year to date. Okay, so that's recent balance sheet trends, total assets of the Federal Reserve Bank. Okay, so we've gone from 9 says, okay, 9,000 thousand, so 9 million. Where is that? 9 million million. Is it 9 million? Millions dollars, yeah, so that's nice. Yeah, 9 trillion, as I thought so, but I just want to check. So 9 trillion, or less, almost 8.9 trillion. And we've gone down to this, which is 8.6 trillion. Okay. So just let that sink in. It is not peanuts, and it's quite a difference. And that is set to continue. So if you put it into 1 year, we've basically gone back to levels of this, basically about a year and a half since the start of the first lockdown, March 2020. Just a bit more than that. So that's kind of where we are. And if I put it to maybe all, okay, so that's where we are. It's quite a journey, isn't it? The Fed and the sort of global stimulus is taking us on. But anyway, so let's not keep this going too long. I just wanted to go back and finish by saying that this is having an impact. I think it was Michael Kramer who said something about that, and it was the Fed is basically trying to tighten conditions, and basically financial markets are doing the opposite, as you can see from today. And that is usually something that has the reverse effect. So we need to hope that there's an inversion in this tendency to fight, you know, what the Federal Reserve Bank is trying to achieve, which is to fight inflation, obviously using the tools at its disposal. But that's not always possible. And so here you go. That's my comment there. So my response to Michael, who posted this today, it always goes back to basics. When the market when markets rise, financial conditions ease, which means the Fed is moving away from its target of restrictive policy. So there's the chart there. So that's the ChicagoFed National Financial Conditions Index, or it's quite difficult to NFCI index. And that's the black line. Okay, so so you can see how when we have a drop in the S&P 500, SPX, the Fed, Chicago Fed National Financial Conditions Index rises. So essentially, rising chart here means that conditions are tightening, and dropping chart means that they're easing. So if you look back to 2020 there, easing conditions, rising SPX, dropping SPX, tightening conditions. So every time this happens, obviously that happens in reverse. Now, the adjusted National Financial Conditions Index is slightly different. I think that's the dotted line there. I'm not sure how it's adjusted again, but I'm just crediting Michael and Mock Capital because that's his chart, and I just wanted to show this to you because it does create an impact there. The middle line there is, I think, a historical average or neutral, so just below that. Historically, as you can see, We've got to a neutral usually, and then reversed. We got to or above and reversed, so we're sort of there, and it's sort of pivotal moment. Excuse the pun, because everybody's going on about this pivoting. Currently the SPX was still within range of today. Actually, we've just gone beyond. We've achieved 5.7 according to this, which is quite impressive. I'll grant you that. I cut down my size. I had 0.4 and it's 0.2 position now. So I cut down 0.1 and another. So because it was just learned from my lesson a couple of weeks ago and decided to check my margin and just keep within reason and not push myself too much. So essentially that's kind of what's been happening. Not much happening tomorrow in terms of data releases, etc. So just have to say thank you very much for watching, and I have more interviews planned actually. Speaking of interviews, there will be more releases coming up, but I'll continue doing my actual analysis videos as well, because there's a lot happening obviously in the weeks to come, so it was interesting to see what price is doing. So until next time, good luck trading, and see you in the next video.